Justin was named by Entrepreneur Magazine the Warren Buffett of lifestyle investing. He's the founder of The Lifestyle Investor and a master of low-risk cash flow investing. Justin's ethos is to create cash or to create wealth without creating a job. I am so grateful for you and your time. And yeah, brother, the floor is yours, man.
Do you want blissful balance in your personal and professional life? Great. What's up, guys? My name is Kerry Jack, and I want to help you happy hustle a life you love, one full of passion, purpose, and positive impact. I'm a lifestyle entrepreneur, a professional model / actor, a digital marketing specialist, a podcast host, author, a biohacker, an eco-warrior, a martial artist, a hippie cowboy, and a humanitarian. My goal is to educate, inspire, and entertain you to live a life of passion, purpose, and positive impact. It is time to happy hustle your dream reality. Yee-yee!
Well, thanks. I'm excited to be here. Thanks for the nice intro, Kerry. It's been wonderful getting to know you, and it was cool just watching the last 15 minutes, seeing you, in action, and your spreadsheet, your tracker is incredible. I hope people are really leaning in on that. That is fantastic.
Thank you.
Getting a chance to go to Medellin. We had family living there for 5 years, so I had the luxury and privilege of spending a lot of time there.
Oh, wow.
I would just highly, highly recommend getting there. It's an incredible place. It is not dangerous like the media has portrayed. And it is just a wonderful experience. So, hey, I want to just start off real quick. Number one, and say I'm super impressed with Kerry. I think you've got an awesome leader, super knowledgeable, but going through relevant information, like not just talking, not just like, speaking, about how great he is or about what you should do, but actually like technical work here, because what you measure is what is improved, period, plain and simple. You don't pay attention to it, it's really hard to improve it. What you measure, that's what grows. So I love that this is based on actual like numbers and data and all that. So well done. I want to make sure I leave a bunch of time for Q&A. I've found that for me, often the most value in a message tends to be when I can get my specific questions to my specific situation answered. So I'm going to go through some things, but I definitely want to leave a lot of time. And I just want to plant that seed ahead of time that I love fielding questions. You can ask me anything. I'm an open book. There's nothing taboo. We can talk any number, any business, any whatever, right? We can get into it. So be thinking about questions. I'm going to go through some slides, but be thinking of questions. And then let's see, T, I'm going to see if I can share this thing properly. So do I need to hit present first on my end and then share, or share, then present?
Present and then share.
All right. See, you guys, I can't do anything without my team.
Thank you, T.
Yes. All right. So we'll just do this presenter mode. Let's see if this works. You guys will have to tell me. So I got to share. I can't even tell. Window presenter. I can't tell which screen I'm supposed to share. All right. Let's see if this works. Is that the right screen?
Yeah, we see it.
Nope. That's the wrong one. That's my presenter notes. So let me try that again.
No, we can see your slide deck.
I think I'm supposed to share.
I think you got to share just like presenter.
There we go.
Yeah, full screen. Yep.
There you go.
Let's go. All right.
Okay. Is this working?
Yeah, and then press present, and then present full screen.
Yeah, I got it.
Yep. Yeah, and guys, I mentioned it, but put your questions in the chat too. That way we keep track of them and we can just go through them in that fashion.
All right. Is this working? Can you guys see this?
Yep, we got you.
All right, cool. Thanks for being here, T. Thanks for walking me through it. All right. Always good to have technical people around. All right. So I'm going to dig in. So today I'm not going to spend a lot of time at all on the 10 commandments, because that's stuff you can look up, you can learn. I just recently had the updated and expanded edition of the Lifestyle Investor drop. And then just, a subtle little plug for the book. You know, we added about 25% new content to this book, but left, I mean, everything else is still in it. It's just additive. But what I'm most proud of, as this book has really gone viral, it became a #1 Wall Street Journal bestseller and USA Today bestseller. And what I'm most proud of is that all the proceeds of the book go to fight human trafficking. And we've now been able to donate hundreds of thousands of dollars. We may either this year or next year eclipse $1 million in donated money, because the Lifestyle Investor is now a top 1% of all books ever sold. So really cool, really humbling, really awesome.
Well, guys, we got to clap that up. Like that's hard to do. Top 1% of books ever sold. And he's giving away all the money to an amazing cause. God, legend. I told you guys are going to like him. All right, go ahead.
Well, I'm just happy to, be here with you guys. I thought this would be really fun. What is your network worth to you? When I think about that, I think, I was really intentional in the early days to build a network when I didn't really have a network. That, back when I was trying to find one, there weren't masterminds, like those didn't exist. I mean, I guess old school, like Junta Group with some of the big names like Ben Franklin, all that, that was there, but not in the way that they show up today. I didn't have podcasts. I went to the library and I checked out books, and no one in my ecosystem was, an entrepreneur. I mean, everyone was like working class. And so I had to be super intentional to find the people that I wanted to be like. And I started taking people out to lunch early and often. I mean, at the beginning, I remember like I didn't even have the money. I was taking people out to coffee and ordering like, a tea myself or a hot water or something. Like I remember like when I didn't have a lot of money and I, shelled out for some of these meals, but I made a practice of taking someone out once a week for literally over 20 years. I even did this on vacation when I go on vacation. And so you compound the thousands of hours of education and it built something pretty incredible. But what I find is most people are not good at networking for what they really need. Business owners are good at networking for business. Most people don't go beyond that. So the interesting thing is, and here's a question just for self-reflection, do you network for wealth creation? Like, who's your network for that? Who's your network to compound wealth in a massive way? I think it's important, by the way, that you have business masterminds. And I applaud you for being part of the Happy Hustle. And many of you are probably part of other groups. I think it's important to be in and around the table of a lot of these groups. I've got 2 masterminds myself, and then I'm a member of 14 masterminds. So I have 16 different masterminds I spend time in. But I don't try to go to everything. I try to go, all I need to do is get an ROI. How do I do that? Well, I'm really intentional. And it's almost always relationship driven, mindset driven, like one connection can ROI whatever the dollar amount is. And so I try to be intentional about what I go to. My wife would kill me if I went to every event in every group, right? So I'm just really picky. I go to things in every group and I really dive in. So I thought that would be kind of a fun way to start. The most common question I'm asked is, Justin, what is the single best investment that you've ever made? All right. So I get this all the time. And people are always eager to know when I keynote, people always want to know this question. And my answer is probably a little different than what you would think. My answer is actually world-class tax strategy. Some of you are probably thinking real estate, you were thinking private equity, you were thinking whatever. No, actually, the best investment I've ever made is to finding a world-class tax strategist, not just a CPA, a tax strategist that works in combination with a world-class CPA, because I want to pay little to nothing in taxes. I want to do it legally. I want to use the system the way that it's built. And the thing is, most people do not have a CPA. They have a paper filer. They have a tax submission expert. They don't have a strategist. They don't have someone directing the ship. And so if you think about $30,000 of savings over 10 years, that's $300,000. If we, compound this over 10 years at like a 15% return, which is very common, very reasonable in the world of alternative investments. So, basically if I could show you charts all day long that basically shows that in public equities, the stock market, you're going to all day, every day average about a 7%, maybe 7.5% return. And then on alternative investments, it's generally going to be around 15%. Okay. So let's just say 15% here. We're not doing anything crazy. That's $1 million over 10 years, but over 30 years, that's over $13 million. And what if we save each of you 50,000 a year, 100,000? What if you learn one strategy and only one strategy, and that one strategy generates 6 figures, or in some of your cases, 7 figures in perpetuity every single year? I mean, that's what one good strategy can do. I don't have animations here, so we'll just I'll give you the answer. Sometimes I have a little bit of fun here. But when you have money that is doubled in a tax-free vacuum, meaning it grows tax-free, versus you have money that is getting taxed, regularly every single year, I want you to look at the difference in that money. $1 doubled every year in a tax-free vacuum at over $1 million in 20 years. And obviously I get that you're not going to double your money every year, but over the course of 60 years, this is probably going to be comparable, maybe 45, 50. But take a look at the differential on the taxed side of things, $28,000. That's a massive difference. So number one, think about what tax strategy can do for you, because this is taxes. We're talking about tax savings right here. Number two, we're talking about investments that are in tax-free growth vehicles. Vehicles like whole life insurance, private placement life insurance, Roth IRA, solo 401k, or backdoor Roths, right? All these have the potential of doing something pretty massive. I feel like we are trapped in this world that focuses on net worth, that net worth is the end all be all. And for whatever reason, that's the barometer that everyone is measured by. It's a horrible barometer. I mean, I really think like a better barometer would be character, values, how kind you are to other people, relationships. Unfortunately, society says, no, net worth is the number. But where they get it wrong is net worth is so subjective. In most cases, there's no utility. And in most cases, people overestimate and exaggerate what their net worth is, even fooling themselves, because people that own businesses always say they're worth more than they are, because the acquirer doesn't pay what you think they're going to pay because you are removed from the business, which is a key component of that business. But I'm going to say all day, every day, financial freedom trumps net worth. And I'm also going to let you know that for me, this was very relevant because I was financially free before I was ever a millionaire. And I think financial freedom is going to trump any aggregate number, any aggregate net worth, because the goalposts just move. I mean, once you hit 1 million, it's like, okay, what's next? Once you hit 5 million, once you hit 10 million, once you hit 50 million, I mean, the goalposts move, the target changes. Get financial freedom, that changes everything. So just thought I would share that. My broker screwed me super early on in my investment career. And I learned a very valuable lesson. I early on trusted financial institutions. I trusted financial planners and advisors. I bought the lie. I bought the manipulation that they could give me a statement that said my average rate of return was this positive number when my actual rate of return was not. It was negative in some cases. I don't know if you guys know that happens. And so I learned real fast, I cannot outsource my financial education to someone else. I have to own it. I have to own my own financial education. that was massively important because the financial services industry is based on a faulty premise and a misalignment right out of the gates. They are paid on assets under management, which means they make money when you lose money. That to me is incongruent. On the alternative investment side, the primary means of payment is performance. They make money based on how things perform, carried interest, the success of that investment. That just felt like way more alignment for me. So I want to talk a little bit about the asset allocation of the wealthy, because when I was younger and my influences, like my mentors, all they did was invest in the stock market. All they did was have financial advisors. I thought that's what wealthy people did. I thought you just put your money in the stock market. But we've learned that that's not the case. And I started, I went down this rabbit hole because I was like, how can I get all these statements saying my average rate of return is a positive, 7 to 10% when I actually lost money. And I don't know if this has ever happened to you. And if you haven't checked it, check it. I did my own math, and my own math when I was doing actual return versus average rate of return, it was pretty substantial. Real quick math, just in case this doesn't resonate. Year one, you make 50% return. Year two, you lose 50%. Year three, you make 50%. Year four, you lose 50%. What's the average rate of return? Anyone?
You lost me. But
all right, year one, 50%, zero. Yeah. You went up 50%, down 50%, up 50%, down 50%. So your average is zero. But if you put $100,000 into that category, multiplied it by 50%, then took that number and multiplied it by negative 50%, do that again times 50%, do that again times negative 50%, it's actually a loss of 46%. So the average rate of return says, oh no, you broke even. The actual return is you almost lost half your money. And that's one of the biggest manipulations I've ever seen. And so when I learned that that's what they were doing with statements and doing with me, and that I was losing money when my returns said that they were positive returns, I was like, okay, what are the wealthiest people doing? And here's what the wealthiest people are doing. Well, first of all, they make the vast majority of their wealth via concentration at the onset, right? And this is like your standard business owner. Most of your wealthy people started out as business owners. But there's a lot of risk in owning a business and having all your assets in that one single business, So a lot of them want to sell, or they at least want to diversify while they're business owners, so they're not left in a rough spot if another COVID comes or whatever. So they grow their wealth, and they actually build the majority of their wealth via diversification. And so that's just an interesting thing. So when you break down the grid of where do the wealthy put their money, it's in 4 quadrants. So we'll start with private equity. And on the left-hand side, you got private equity and real estate. So those are alternative investments. And generally, that's 50% of the net worth of wealthy people, because you can get outsized returns. You're going to earn more than the stock market. I've got charts and graphs that show this all day, every day. This is the stuff I geek out on, is, researching what wealthy family offices do and wealthy individuals do. Most people think that the majority of their wealth is in the stock market and public equities. But did you know that really only 15 to 25% of their portfolio is in the stock market? And that 15 to 25% is there as a hedge, like long-term, we think the US economy is going to go up. And by the way, did you also know that 95% of money managers do not outperform the S&P 500 index? So what that means is most people pay someone to manage their money to do worse than if they just did the cheapest way of getting into the market via an index themselves. So 95% of the time, people pay someone to underperform the cheapest way to get in, the lowest fees of just investing in an index. Fascinating. But for those that do have, public equities in their portfolio, these wealthy family offices really use it as their buying leverage. So they will borrow against this and use debt to buy more alternative assets on the other side. So instead of having a sale where they would pay taxes, they borrow on margin against it to purchase the assets. They refinance those assets. They then take that money and pay off the margin, pay off the debt on their public equities. And then there's everything else. So we could talk about private credit being in there, which is really big. We could talk about, this is where everything would break down into commodities and crypto and precious metals and, everything else. Does that make sense? All right.
Yeah.
So I'll keep going. So, for me, financial freedom was so important because I wanted to own my time. I didn't want to continue trading time for money. The weird thing for me is people would say, well, what do you do? And I'd say, well, I'm a business owner. But that wasn't true. My business owned me. That was what was true. Like I was working more hours. Now, sure, I was making more, right, than what I was in the past, but my business and my possessions had their grip on me. It was hard for me to divorce time from money. My time is what produced money. I wanted my assets to produce money. And I had to figure out, what does that look like? And it wasn't that I didn't want to run my business. It's that when I got my financial house in order, I made better decisions for my business. When I didn't have to make money for the business because passive income covered it, I started making decisions I should have made a long time ago. Because the fulcrum of like investment decision, should I do this? Should I not? For most of my entrepreneurial career was, can we afford it or not? That's not always the best question to ask. What's best for the business? That's a better question. What's best for customers? What's best for employees? We could go on a whole series of better quality questions than can we afford it? Can the business afford it? So once I solved financial freedom for me personally, and first it was my wife, then it was me and us as a family. And then it was like, let me solve that for my business. I started making really smart business decisions because I wasn't handicapped by needing to make a certain amount of money. I could then hire in a C-suite. I could take chances on this new AI thing. I could, move this person from this position over here because I think they're better suited. I could, outsource, to the sales team and see how they do and split test versus having an in-house sales team. Like there's so much stuff that I could do that allowed me to scale my business faster because I didn't have to make decisions from the framework of can I afford it? And I'm like stuck in this pattern of only doing things that produce a certain amount of income because it's safe and I know it works. Does that resonate with anyone?
Oh, yeah.
For sure.
So, I bought my time back originally with the purchase of a mobile home park. I bought my first one. That one actually replaced my wife's income. So, ironically, the first park I bought was, the cash flow from that deal was within $1,000 of my wife's annual income as a teacher. So she retired. We had our family, which is really cool. And then, I bought another mobile home park and that replaced our survival income. So I bought my wife's time back first and her freedom. And then I bought mine. And then from there, it was just kind of icing on the cake. So you start at survival income. And by the way, survival income is a great thing. It's not lifestyle income, but it's like all your expenses, like everything's covered. You're good, right? All bills are covered, but you're not taking fancy vacations, but that's okay because all your bills are covered. That takes a huge mental weight away. That, like, my experience was, holy cow, I don't have to do as much. I can choose to do the things that I want to do, that I like doing. I can outsource more. I can delegate more. I can, pay to bring other people in to do things. That was huge. And then we bought another mobile home park, and that one replaced our lifestyle income. And then we sold that and flipped that into two more. And that replaced our active income. So like the total amount that the business was bringing in.
Whoa, whoa, whoa. Apologies for interrupting your programming, but I have to tell you, the best investment you can make in yourself is one in which helps you acquire skills. You've probably heard people talk about, oh, just invest in yourself and you'll be successful. Yes, that's true to a degree, but you have to invest in skills that will ultimately help you achieve your desired results. And I think one of the best skills one can possess, be it an entrepreneur or an aspiring entrepreneur, is the sales sword. Really knowing how to sell, utilizing pressure-free persuasion, which will make you more money and more impact. Now, if you want to know how to sell more efficiently and effectively, I just launched a sales course called The Proven Roadmap Process to Selling Millions of Dollars and helping you to increase your conversions guaranteed. And you can get access to this new sales course that The Happy Hustle is launching at thehappyhustle.com/sales. And if you act fast, you'll get it at the lowest price it'll ever be available, because we are launching it and we want to gain amazing testimonials and social proof to further share this knowledge. So if you act fast, you can get it at the lowest price it'll ever be. That's at thehappyhustle.com/sales. Now let's get back to this episode.
So at first, lifestyle, that didn't count, that didn't count savings and investments, but it made a seamless transition so that we didn't have to work, and my wife didn't feel the pain of like taking the leap of faith to see if we could make this work with no money, right? So that was important for her. So I did it that way, even though I could have done it the other way. I did it the safe way, which was longer, but it was better for us as a family. But once I had my earned income covered, well, now I have lifestyle plus investments all covered, which is cool. And I was able to then cover the cost of running my business all with passive income. But what I learned is that we went and traveled the world for a year and had a blast, went to 13 countries. I took a year off. I literally did not work for a year. It was hard. It sounds weird to say it. It was actually really hard. By week 5, I had shaky leg and I was like convulsing, like I had to do something. And then I got into the zone and found some peace. And then really I got a little like antsy again at like 5 months, but I just kept on moving. And the one thing that I learned is that I journaled a ton, almost every day. And I learned I love to read. And the more that I learn, I love to teach. I love coaching my friends to financial freedom. And I love doing deals. And so that's actually where the lifestyle investor came from, is like, well, why don't I turn my hobbies, the stuff that I did for a year for free, into, a really cool mastermind and community and book and podcast and all that. So that's ultimately what we did. Had this breakout article that went viral that also included a lot of private information that I don't know how they got and I did not approve. So now all of a sudden I felt like I was really naked in the public eye because no one knew anything about our financial success. When I say no one, my brother didn't know, my parents didn't know, my grandparents didn't know. I mean, people were hitting me up like, holy cow. What, it was really a crazy experience. My wife's even like, oh, I didn't realize we were, because she doesn't care about money or any of this. She's like, I didn't even know that, we were doing that well, which is quite comical. But one of the things I learned from some of my mentors is if you want to upgrade your play, you got to surround yourself with people playing the game of life at a higher level. Warren Buffett always talked about, who are you learning from, and to be able to spend time with Richard Branson and Robert Kiyosaki and Ron Paul and tons of other people. It's been a real gift because it's elevated my thinking. It has really impacted everything because I don't want to play small. It's called me to play a bigger game than maybe I would have played had I not run into these people. And so when I think about money, I think about it in quadrants. I think about a lot of things in quadrants. And part of the reason I think about things in quadrants is because Robert Kiyosaki had a huge impact on me when I was very young. I read his book. Well, of course, Rich Dad, Poor Dad, but the book for me that was the aha was Cash Flow Quadrant. I mean, that one just blew my mind. And so he laid out this quadrant of employee, self-employed, business owner, and investor. And I was like, oh, that makes sense. I never thought about it like that. And I also thought I was a business owner when really I was a sole proprietor. Because he said something in his book. He's like, if you can't leave your business for a year without it maintaining or growing in sales, without your active involvement whatsoever, you do not have a business. You have a sole proprietorship. So I was like, wow, I'm not even a business owner. I need better systems. I need better people. And then I had this realization, I don't even know if I want to be a business owner long-term. I actually think I want to be an investor long-term, and I want to pour into businesses. And, I can still get I still love like solving problems, but I don't want to be like the day-to-day grind. So that was just huge. So now I just think of the world in quadrants. And so, I think about money. Most of the world is not good at making money, right? We all know this. Like if we break it all down, the top 1% is good at making money. Okay. Maybe the top 2%. Let's just call it the top 2%. Okay. From there, if you move over on the top, you have an even smaller percentage that's good at managing money. But then you have such a small fraction of the world that's actually good at multiplying money. And I actually feel like that's where most of or a lot of my gifting is in the multiplication of money, the multiplication of wealth. And then I think it's really important. And I heard you guys talking about this, earlier with Carrie, and the one of you that is spearheading one of your companies for impact. It's making money matter. And I do think that as entrepreneurs who make more money, we have a responsibility to give back in a meaningful way. I also think that when we give in a meaningful way, and it doesn't, I aspire to be a radical giver. That doesn't mean I always am, because I still wrestle with it sometimes, So I can say I'm a giver and I'm a good giver. And I will say that there are seasons of life I've been a radical giver, but I aspire to always be a radical giver and to not let scarcity creep in there and be like, well, what if this happens? Or what if this falls apart? Or, keep some money back, be protective. Because I think if we can, generously dish out our money, then I think it eliminates the grip that money can have on us. And I think that's really important, because otherwise money can become the idol that is at the top of the pyramid that becomes more important than anything else. And by the way, you see this in politics. You see this in a political season. I'm not going to get political with you guys, but what you will notice is the toxicity in, and just pay attention the next few months. And I know you've seen it, but when people put politics above relationships, you see this horrible polarization that happens. But people do that with money, and most people don't bat an eye at it or don't even consider it, right? So I just think we got to keep it in place, like relationships up top. And for many of us, it's faith up top, right? And then relationships, and then, we can kind of move through the hierarchy. So why private deals? Why do I like to invest in alternative investments? Well, it has to do with efficient and inefficient markets. And when you think about the stock market, that's as efficient as it gets. It is so efficient that there are micro trades. There are algorithms that trade. AI is trading. Quants don't even trade anymore. Quants build algorithms that trade, and they can trade 1,000 times for every one time you trade. If you think you are ever going to have the edge as a trader, read the book Flash Boys by Michael Lewis, one of the greatest authors of our time, and you will recognize you don't ever stand a chance in the trading world. And even if you did win 1 year or 1 season, over the long haul, it's virtually impossible. Inefficient markets are alternative investments. So, like real estate, that's an inefficient market. Well, how do we know that? Because we get larger returns there when done properly than in the stock market, because there's less institutional money playing in that arena than, just mom and pop money, than just, baby boomer money or money from us as business owners. Think about your business. How are you able to run your business? How does that exist? Because it's an inefficient market. If it was efficient, you wouldn't be able to have an opportunity to get a slice of the pie. Now, your job is to say, hey, this market's inefficient. I'm going to start a business here and I'm going to make it more efficient, right? But the whole reason your business exists is because of inefficiency. So we actually want to play as much as we can in inefficient markets. And so private deals have way more inefficiency because there's less professional investors in that space. There's also like way more companies. I think the stock exchange now is down to just like 4,400 companies. Private companies like 220,000 or something. So I mean, it's a massive difference. Now I'm going to talk about something else in a little bit that's really important. But let's talk alternative investments. And by the way, I just want to go back here. Alternative investments. That whole word is funny. This is a term created by Wall Street so that most people think that, oh, the stock market is how you invest. But some people have alternative investments to that. And I say that's funny because what percentage of the net worth of wealthy people is actually in alternative investments? You guys remember? It's over 50%. In fact, I study this data from the who's who that build these, data sets on all the family offices. So JP Morgan has one, Goldman Sachs has one, KKR has one. There's a bunch of aggregators of like the top 200 family offices. So I study all these. I'm part of Tiger 21, so I see their asset allocation. And I'm part of a bunch of other groups where we dive into it. And so every one of these consistently across the board has between 50 and 59% of the net worth of the wealthiest people in the US in alternative investments. So private credit, private equity, real estate. Okay. So what Wall Street wanted to be alternative investments and wants the general public to think is like the small little sliver. That's what the wealthy invest the majority in. And then the small little sliver is actually the stock market. When becoming an investor, I'm not going to spend a lot of time here, and I really want to make sure we got a lot of time for question, but it is so important that you create your own investment criteria. What do I mean by that? It's a list of questions or a list of criteria that you have that allows you to make decisions about investing, but you make these decisions from a good frame of mind so you don't make an emotional decision when you need to be making a logical decision. And so you do this early so that way someone can't be like, we got this investment is a once in a lifetime deal and you got to get it in the next 48 hours, right? Like that type of stuff starts to mess with your mind. You get FOMO, and that's just not a good way to invest. Most deals are bad. So this is one of the points I want to get to. You got to be careful that you're not an optimist. The optimist thinks that every deal is a good deal. The investor recognizes that most deals are bad. So if you want to get ahead, you actually have to say no more than you say yes by a large margin. All right. So the mindset of an investor of good versus bad. When I was a brand new investor, I was like, oh, this is really good. I'm excited. Let me see if I can find any reason not to invest in it. But this thing sounds so good. What an investor does, that's the optimist. The investor says, this is a bad deal. I'm going to start from that framework. And unless I can prove otherwise, this deal is bad, right? You're going to say no a lot more then you're going to say yes in that situation. So let me just escape out of this. Let me stop the share because this gives us plenty of time, 22 minutes of Q&A, and we can get into anything that you want to get into. So hopefully that was a helpful walkthrough and an overview of like what I do, where I've been, the stuff that I study. Hopefully there's some good learnings in there.
Yeah, I love it. Hey, little round of applause for Justin and at least that beginning part, guys. All right, so Justin, so we do have one gentleman, Jeremy, who he has reallifetrading.com, all based on stock market investment. So I'm curious, he had a question. Jeremy, do you want to ask it first? What is the balance of decreasing tax, or do you want to kind of rephrase
Go ahead and read it for me.
Okay, you said, what is the balance of decreasing taxable income so you never pay a lot of taxes, but actually making money on paper so that it becomes easier to get a loan? Good question.
All right. So as business owners, it's always an interesting play. You know, you're often making more than what you're showing. I think that there are tools and there are strategies so that you always have capital. One of the strategies I implemented early on was kind of creating a family bank. You know, even before I had a family, I had this whole life policy that I used as my bank. I just kept pouring money into it and then borrowing against it when I needed it. And so I was able to build my own credit facility when banks were difficult. Now, the other thing is most of you probably have businesses that have some sort of assets. So you should be able to get some sort of line of credit. Another thing that you can do is you can get a line of credit on your home, a HELOC. And so those are, I like establishing lines of credit when you don't need them, because when you need them, you're not going to be able to get them, right? So you establish them early, and those can act as backup plans if you're not able to get the money that you want. Now, there are plenty of specialty finance companies out there that understand what entrepreneurship looks like and that you are going to write off as much as humanly possible, and your tax return is not your real financials. I used to have two sets. I used to have I had my P&L that was my real deal P&L. Like, this is a true, because I have to know what's going on in my business. And this is my tax P&L. This is what I'm going to send to my CPA, where I'm going to be super aggressive, because I have to know that I'm running the business the way I need to. But then over here, I need to know that I'm getting all the write-offs that I need to get. And so, you know, my effective tax rate for a decade plus is, you know, has been under 10%, and most years has been at 0%. But my income has grown virtually every year that I've been in the workplace. So there are strategies out there, and there are credit facilities and specialty lenders that understand our world where you can get that done. But get ahead of yourselves and establish lines of credit now.
Yeah. Yeah, great question, Jeremy. And, you know, I think that's something that every entrepreneur kind of wrestles with. I'm curious, you know, Nick, I know you had a couple, or you might have had a question or two. Do you have anything to ask Justin?
No, I guess, I mean, the bottom line, I guess what I would ask is, Justin, with what you're offering, is it more so like an education to help people understand their own investments? Or what is it exactly that you're proposing in order to get people in the right direction when it comes to market-based assets? Because you were talking about like whole life and some of the non-market-based assets, but I think the market-based assets is the one you were challenging, correct?
Yeah, and I don't think that people should not be in it whatsoever. I just think that people need to be careful not to be over concentrated in any, you know, in really any area. So what ends up happening with entrepreneurs is the vast majority of their net worth is in their business. So if that goes bust, they go bankrupt or they go close to bankrupt. And then when they do invest, the majority of that is in the stock market because they don't have the time and space to do anything. They just want to outsource it. So now the majority's here in the business The next largest chunk is in the stock market, and it's just not really well balanced. So I think having a good balance of what is in the stock market and what you're going to put to that versus what you're going to put on the alternative investment side really matters. And I also think anytime you can take money off the table in your business, it behooves you to at least consider it, right? If you ever have the opportunity to partially cash out or fully cash out, it's a real consideration. Entrepreneurs can start other businesses, especially when you know some of the niches that exist and some of the opportunities that are there. So I'm not against public equities. I'm against all or majority of assets in public equities. So I just like to teach and educate. Now, we do a ton of deals on the alternative investment side. I mean, we generally are doing about 30 deals a year, and people pick and choose in our community what they want to do. But no one has to do anything. I just like to teach people, number one, have your investment criteria. Number two, figure out what your current asset allocation. Number three, what is your ideal asset allocation?
Yeah.
We're gonna need the damn AI meeting recap notes on this one, okay? Who's ever got your little,
Yeah, we
little
are.
spies in here.
Yeah, lot covered. All right, Chris, what's your question?
So what do you you had mentioned mobile parks earlier. There were some comments earlier that it was like, yeah, maybe it's good now, maybe it's not. Do you have any kind of just top 3 strategies that you generally, recommend top of mind that work for most people?
Yeah, I mean, so like I kind of look at 2 different things. You can go the real estate route, you can go the business route. And by the way, there's other ways that you could go too. I mean, if you have the funds, you could put a ton in, treasuries with some allocation of private credit, get some cash flow, et cetera. But the 2 main ways that I see it is like real estate and business. With buying another business or starting another business, it's high risk, but it could be a big reward. The part that most people don't consider, that they think that they can outsource everything, but really they end up buying a job. The operator, falls through.
Right.
They end up, so that one is like, it's tougher to me. So for an entrepreneur to buy another business, I'm always like, consider all those options. Because on the real estate side of things, it's, you don't have this high of a ceiling. You're probably gonna get 10 to 15% appreciation growth over time, but per year. But if you buy right, it's hard to lose money. Or if you lose, you're not losing everything, right? It's not an all or bust. And in real estate, it's not too late on the mobile home park side. It's still the least consolidated real estate asset class out there. And then, I would say industrial is probably the next least consolidated, but there's been a big push on both of those. So if you look at the last 6 years, the top 2 performing real estate asset classes are mobile home parks and industrial real estate. And again, that's because the least amount of institutional money is in that. So you can still buy good assets.
Interesting. Yeah, I mean, I'm curious. Oh, Matt has a question too, but I guess real quick, Matt, let me ask this. What's your take on Bitcoin and cryptocurrency?
Are you asking Matt or are you asking me?
Oh, no, I'm asking you, Justin.
Okay.
Matt had a question though, but
okay.
I skipped him because mine was in there first.
Well, I'm a big fan. So remember in the quadrant that had like, we had 4 things. We had private equity, we had public equity, we had real estate, and then we had everything else. Yeah. So, the more progressive family offices that are younger or have younger management in them generally allocate about 1% of a family's net worth to crypto, with the majority of that being in Bitcoin. So to me, it's a no-brainer to at least do that. Because if you lose everything, it doesn't change life. Like your life goes on, from a material standpoint, just like it ever did before. But in the event that it takes off, I think it's pretty powerful. It's the risk reward ratio there is pretty substantial. So, I'm probably a little more heavily weighted in Bitcoin. I do like Bitcoin. But I'm not a maximalist in anything. I believe in having a good diversification across a whole bunch of different assets and asset classes and sectors, so that no matter what happens, I'm in good shape. So I don't want to go all in on anything. I'm not all in on Bitcoin. I'm not all in on gold. I'm not all in on stocks. I'm not all in on, private businesses. It's a little bit of everything. But I think if you're 1 to 5% of your net worth, you fall within what the wealthiest family offices are doing for their centimillionaires, demi-billionaires, and billionaires.
Awesome. Yeah, thank you. All right, Matt, you want to ask your question, Matt? Or you want me to just read it off? Or go ahead.
Is my
Yeah,
microphone working this time?
Yeah.
Perfect. Justin, it's super interested in the book. I actually just bought it a minute ago, so I'll read that next on my list. I'm curious, because my wife and I have started having this conversation. How do your allocations change as your sort of life? I've always said that you have survival, lifestyle, and legacy buckets, which I didn't know you had a whole book on it, so that's kind of cool. But once that survival and lifestyle bucket gets filled, whether that's in the passive income stream or just a bank account that's got $3 million in it and it pays enough dividends, it covers your lifestyle. Do you start to get more aggressive with the things you're pursuing at that point, or are you still adding doubles and singles as often as you can, just more frequently?
Well, I'm pretty risk averse in general. So I am much more comfortable with singles and doubles, and hopefully something turns into a triple or a home run. But I can tell you that my tolerance has grown the more that my lifestyle is covered, right? So, in the early days, I didn't make a lot of home run swings. My goal was, let me get my passive income up. Well, now, once my passive income is there, I've got 1% of my asset allocation that I allocate to early stage companies, to angel investments.